Good afternoon, everybody, and welcome to the latest event in our series of Professional Advisor Working Lunches. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. Before we get on with today's session, let me quickly run through the usual housekeeping. As it says on the screen, your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It will ensure there's no background noise, so myself and our Baillie Gifford guest, Alasdair McHugh, can be heard more clearly. I should also inform you that this session is being recorded, and we'll send you a link of the recording by tomorrow. You feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link of to the recording of the session, which will arrive in your inboxes tomorrow. However, to receive your CPD, we need to know you've attended this event. So if your name isn't in your Zoom icon, you can expect a message from Joe Gilby asking to confirm who you are. You don't want to miss out on that sweet CPD, so be sure to respond in the chat function when Joe contacts you. Now, I don't know about you, but I've listened to a wave of presentations on ESG this year. With the COP26 conference still going on in Glasgow, there's never been a time when people have been more aware of the importance of action on climate change than right this moment. Over the last few years, the investment industry has been fast to release a host of funds and products to offer a variety of sustainable or ethical twists on their funds. Along with them, there's no shortage of acronyms and jargon in the ESG space, with so many new strategies coming on stream. So today, I'm delighted to be joined by Baillie Gifford's Alasdair McHugh, who is a product specialist on its global stewardship strategy and a member of their portfolio construction group. Since joining the firm in 2011, Alasdair has also been a member of the Baillie Gifford Environmental Sustainability Group. So in the next 25 minutes, Alasdair will attempt to strip away all the acronyms and tech talk, and will tell us about 3 sustainable growth trends that Baillie Gifford believe are redefining ESG. You feel free to put any and all of your questions to Alasdair using the chat function, which you will find at the bottom of your screen. And if you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message. That way only I can see it. We'll have plenty of time for questions throughout the next hour. So just before I hand over to Alasdair, let me quickly run you through our learning objectives for today's session. They will try to answer what are the most disruptive forces that will drive sustainable growth over the next decade, which traits can we look for when attempting to spot the companies that will benefit, and how can we rewire our investment thinking to let us embrace these opportunities. That's the CPD covered. Let's hear from Alasdair McHugh from Baillie Gifford. Good afternoon, Alasdair.
Hi, Tom. Hi, everyone else. Thanks for giving up your lunch hour to dial into this session.
So Alasdair, I think you've got a presentation coming up for us now. Do you want to take it away?
Yes, certainly. So as Tom says, I'm Alasdair McHugh, investment specialist on our global stewardship fund, which is Baillie Gifford's Sustainable Growth Fund. And I think it's fair to say, I agree with Tom that there's been a lot in the media recently, with certainly around COP26, and ESG is very prominent in all of our minds at the moment. So I'm going to try and say something a little bit different and try and provoke a bit of controversy. And I hope that you'll engage me on that and ask lots of questions as we go through. Really, because my colleagues and I are pretty firmly of the belief that the majority of the ESG investing world is just pointed in entirely the wrong direction. I think far too many investment managers are obsessed with assigning really spuriously accurate data points to companies to try and really qualify the risk of them running into controversy. And that sort of focus on the downside, I think, is entirely missing the point. I think ESG investing should be really about opportunities rather than about risks. And in the asset class that we operate in, equities, global equities, that's entirely rational to my mind, because we're operating in an area where the downside is capped, but the upside is uncapped. So you should really spend much more time thinking about what could go right rather than what could go wrong whenever you're analyzing a company and whenever you're thinking about its potential contribution to society more broadly. So today, what I want to try and do is use the session to talk in an unashamedly optimistic manner. And I'm going to highlight 3 real mega trends that I think will provide a tailwind to sustainable growth investors over the next decade. So I'll just share my screen. I'm going to start with a quote from someone one of the few people that saw the pandemic coming, which is Bill Gates. So Bill Gates said, "We always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10." That's something, at Baillie Gifford, we couldn't agree with more. We've seen this play out many, many times with new technologies that looked set to change the world, but then went on to become commoditized. And I'm thinking about things like 3D printing as an example of that, or the other way around, things that started very slowly and then sort of gained critical mass, and shortly after they were ever present in our lives. So the internet's a good example of that, and the mobile phone would be as well, of course. And I very clearly remember myself, the first kid in my class at school who had their own mobile phone was sort of mocked slightly for having a direct line to their mummy, and then a year later we all had our own Nokia 3210. So this has happened many, many times, and I think the problem is that we humans tend to think in terms of linear progression, in terms of gradual evolution and of predictability, rather than the reality, which is that the change happens in moments of crisis, as we've clearly seen in the last 18 months. It is lumpy, it's inherently unpredictable, and there are inflection points. So that's why we try to think left of the decimal point. We try to be roughly right rather than precisely wrong whenever we're thinking about the future and whenever we're trying to pick stocks for the Global Stewardship Fund. So our approach is really to think about the trends that will persist over the next 10 years rather than the next 10 months. And on the second page here, this is the first one of those, and perhaps the most obvious, particularly given the current coverage that we're seeing. But actually, having paid attention to the coverage of COP26 in the news, the one thing I'm sure everyone comes away with is that it's incredibly complex, this transition that we need to go through. But ultimately, to my mind, it just comes down to two numbers. And again, Bill Gates laid this out in his book on the topic recently. He talked about it being the journey between 51 billion and zero. So at present, we spew about 51 billion tons of greenhouse gases into the atmosphere each year. And if we're to avoid the worst effects of the climate crisis, then we need to get that down to zero by 2050. And that's a massive change for humanity. But I don't think it's impossible by any stretch. And there are some things that we can be quite sure about in that sort of future world of net zero. I think we'd probably have a proper price for carbon. Whether we get that COP26, 27, 28, I'm not sure. We'll probably have more electrification of our transport system. We'll have increased city living, which is more resource efficient. I think all of those things will be part of the solution. And they're all, in some cases quite far out into the future. But I think it's worth sort of recognizing that we have come a long way, and that's why on this sort of this chart that I'm showing on the page here, we've got the peak of oil around about 2020 very deliberately, because I think what happened on 20th of April last year was absolutely monumental. So oil prices went negative for the first time in history. And I think the writing's been on the wall for that industry for quite a long time now. So, we've seen the highs of companies like ExxonMobil and Schlumberger all the way back in 2014. And most big oil companies are really, despite what you might read about them, they're in structural decline and have been for quite some time now. So that's the red line on the chart. The gold line is that it's the year by year, decade by decade, even efficiency improvements and cost declines that we're seeing in renewable energy that are really responsible for that decline in peak oil, from peak oil. So the cost of a watt of electricity generated by a solar panel has fallen from about 40 cents to about 4 cents over just the last decade, for example. And in Europe, we went through the 1% penetration level a decade ago for renewable technologies supplying our electricity. And for the first time last year, we were over 50% in Europe, which is a fantastic achievement. So what I'm trying to say is that there's lots of encouraging progress here. There is, of course, much more to do if we're going to meet those carbon neutral objectives by 2050. we're going to need much more efficient methods of heating our homes, which in the UK here accounts for about 14% of greenhouse gas emissions. Within our portfolio, we've got some exposure to some of the solutions providers there. So a company called Nibe Industrier out of Sweden, which makes ground and air source heat pumps that are twice as efficient as gas boilers. I think we're going to see a lot more adoption of that kind of technology. We also, of course, need to convert our road-based transportation to electricity. And here we've got Tesla, which is making great strides, but I think crucially doesn't need to be the only player, and a lot of that industry needs to participate too. And we've seen Tesla really sort of dragging up the rest of the industry in that regard. Zoom, of course, is also taking a lot of cars off the road by way of avoiding business travel. We've got exposure to that as well. But I think it's important to point out that it's not just the innovators that can help with the energy transition. We also need a very big contribution from the companies that enable the deployment of those innovations at scale. So the semiconductor manufacturers like TSMC or Samsung SDI that makes batteries, even Bridgestone that makes tires, we can't do without those with our electric vehicles. They still need tires, but they need to be made in a cleaner and a literally, excuse the pun, more circular way. So it's those underpinnings that are required. It's also the influencers, and companies like Zalando, which operates a fashion platform, is able to sort of drive its customers towards more sustainable clothing choices. Or even companies like Spotify promoting podcasts on the topic on its platform. That can have much more of an effect than it having a look at its own emissions, which are relatively minor. So there's lots of ways that we can play the energy transition, and it's a very exciting trend for investors. I think the industry incumbents here really must adapt or die. And that is really evident when you look at the market cap of the entire US energy sector, which is now less than just the market cap of Tesla. So a big trend for us to play, and certainly a very exciting one, albeit one that you probably expected me to talk about today. The second one, I think, is perhaps a little bit less familiar to you. This is what we're calling scale as a service. So these are platforms that deliver infrastructure services to companies over the internet. And the most well-known of those would be cloud computing. Now, before we had cloud computing, if a company wanted to access computing power, it had to buy servers and it had to install them, had to build its own data centers, typically at its company headquarters. And that was very complex. It required dedicated teams within IT to install and run those servers. It was cumbersome. It took an awful lot of time. And it was also very expensive. So spending millions of dollars up front to buy the equipment, to hire the staff within those IT functions, and so on. And then the complexity and the costs involved in that process was really just putting large companies at a big advantage over smaller ones. So really only the biggest companies could afford to spend the millions of dollars that were required to build those server farms. But what we're seeing now is that cloud computing is changing that equation. And you can see that on the right-hand side of the diagram that I've put on screen here. So computing infrastructure no longer needs to be located on site. Instead, it can be hosted on the cloud and accessed over the internet. And that has made the process a lot easier for smaller companies. They no longer need to hire large dedicated teams to run these services. They can just plug and play into the cloud and be up and running in minutes. And that cloud-based approach is also much less capital intensive. So instead of spending the money up front, companies just pay for what they need when they need it and at a touch of a button. And in reducing that upfront cost and complexity, the cloud model, really what it's doing is it's lowering the barriers to entry and to scale for startups. So instead of needing those massive upfront investments, really only all a startup needs nowadays to get going is a smartphone and a good idea. Now, Amazon was very much the pioneer of this model with its Amazon Web Services division, and that has had tremendous benefits for companies setting up their own IT infrastructure as described. But what we're seeing is that this is spreading out into other areas of the economy, and it's at a pretty early stage, I would say. But two of the areas that we're seeing it emerging in now are e-commerce and communications. Shopify is a great example of the former. It's our largest holding in the fund at the minute. And essentially, Shopify is a platform that sits behind the scenes powering a very big bit of the digital economy. It was a company that started in the early 2000s by a chap called Tobias Lutke, who's of German descent, but is based in Ottawa, Canada. And Tobias was setting up his own snowboard shop, and found that whenever he wanted to sell those snowboards online, the software tools for doing so were really quite poor. So with a developer background of his own, he decided to build his own tools. And quickly, it became apparent to him that he could make more money from selling that software than he could from selling the snowboards themselves. The best way to think about what Shopify provides for its customers is really giving them all the tools they need to manage their businesses online. So they can build online shops, they can run digital marketing campaigns, they can accept payments, manage inventory, all of that stuff. And what it really does is automate those routine tasks and just free up time for the entrepreneurs to focus on their own products. And a great example of that is Kylie Jenner, one of the Kardashians, who managed to build her makeup brand, Kylie Cosmetics, up to $1 billion of revenues with just 7 full-time employees. So in terms of that balancing of power between large companies and small, that is definitely happening with Shopify. We're seeing a similar thing emerge in communications with Twilio, another holding of ours. So again, this is a software platform that allows developers to really easily integrate communications functionality into their applications. So you can build sort of voice calls or text messages directly into your applications on a sort of plug and play basis again. So Uber, for example, uses Twilio to power the messages between its customers and its drivers. And the New York State also used it for its COVID-19 contact tracing scheme recently. And again, this is a company with a founder at the helm, a chap called Jeff Lawson here, who had started 3 companies before he came to start Twilio. And in all 3 cases, he found that communications was a really big part of the customer proposition, but he struggled to build all of the infrastructure he needed into his own company, and it became quite a big distraction for him. So what Twilio does is it tries to solve that problem through software. Again, it sits on top of the infrastructure of the communications industry, and it interacts with that industry on behalf of its customers. So instead of them spending huge sums of money, loads of upfront CapEx, Twilio's customers only pay for what they use and when they use it. Again, as I say, on a plug and play basis. And both of those companies are addressing very large market opportunities, both over $1 trillion each. And they both have very strong competitive advantages, really reinforced by pretty powerful network effects. The idea that the more people come to them for their services, then the more they can invest in providing those services. And I think the icing on the cake for a responsible investor is that, as well as being attractive investments, they're also performing a very important role for society, really making it easier for entrepreneurs to start and to scale companies, and really leveling that playing field between the biggest companies and the smallest ones. And I think the implications of this trend could be really profound for the wider economy. I think over the next decade, you might see more and more startups. We've already seen this to some extent, driving more innovation and driving more disruption all over the world in support of the previous trend I talked about, for example, of climate change. And the exciting thing about this trend is that I'd say we're much closer to the beginning of it than to the end. So that's the second trend. The third one we're calling the Great Convergence, and it's in healthcare. Although I'd say it'd be better described as sick care, because to date, what we've really been focused on with our current healthcare system is treating symptoms rather than actually preventing or curing diseases. But there is a paradigm shift coming in this industry, because what you're seeing now is a real collision of big data and computing power in the form of artificial intelligence, really disrupting what is a highly antiquated industry. So one of our analysts actually visited the state-of-the-art lab of one of our holdings, Exact Sciences, just about 18 months or so ago. And what she actually found was that company still received the vast majority of their orders via fax. In 2019, I think 70% of all medical communications still happened via fax. And I think the NHS only stopped ordering new fax machines a couple of years ago. So in the technological age that we're living in now, that just has to change. This is the healthcare world is just absolutely ripe for disruption, and we're seeing huge amounts of progress here. So the cost of sequencing a human genome has fallen exponentially since 2003, when the first human genome project completed. So the first human genome to be sequenced cost about $500 million, and it took about 13 years. You can now have that done in 30 minutes and for around about $500, and it's only going down in terms of both the speed and the cost attached to that. And that accessibility really creates absolutely reams and reams of data. And especially when you add in things like your smartwatches and all the devices that we're all wearing, the data thrown off by them can all be sort of put together, and in that we can start to see patterns. Or at least artificial intelligence can start to see patterns. So, genetic markers that are pointing to the likely emergence of a particular disease. You can then start to use gene editing techniques that would allow us to avoid the worst outcomes for people, really personalized and preventative medicines. And of course now, we have vaccines using mRNA technology, which is absolutely, the CEO of Moderna refers to his company as a tech bio rather than a biotech. So, very much technology led and using a lot of these themes. An interesting anecdote actually about Moderna is that between them and Illumina, which is the holding in the fund, it actually took just 4 days to find a vaccine for COVID-19. So the vaccine that they built between them was ready on January 13th. That was 2 months before the World Health Organization declared a global pandemic. The other 9 months were actually just regulatory testing and approval. So what's in my arm now took just 4 days to be developed. And, amazingly, that happened without the SARS-CoV-2 virus ever actually entering the Moderna building. It was all modeled digitally and done on what they call lab-on-a-chip technologies. So, great progress in healthcare. I'd say we're more excited about healthcare than ever before, and probably more excited about this theme than any other in the portfolio at the moment. We're seeing lots of new ideas coming through from this area. But what I would say is it's not the big pharmaceutical companies that have, arguably perennially underinvested in pretty poorly targeted research and development. Famously, 9 out of 10 drugs from big pharma companies haven't made it to commercial success. We're much more interested in, as I say, the tech bios, so the smaller, more focused platform companies that have technologies that are, going to be widely applicable to a range of different drug development modalities, and where the drug development is less trial and error and more data driven. Lots of examples about that. Happy to talk about any that are of interest. Ones that are notable to me would be Illumina's subsidiary Grail is rolling out a pilot on the NHS at the moment, which you can read about online. It has 160,000 patients in its trial, and it's looking at a single draw pan-cancer blood test, which can detect up to 50 different cancers. So, progress there is very, very exciting. In the sphere of neurodegeneration, there's a company called Denali Therapeutics that we own in the portfolio. That's the first ever company to get a large molecule drug across the blood-brain barrier, which has been a huge biological challenge so far. So for the first time, we're treating the actual root causes of disorders like Parkinson's, ALS, Alzheimer's, for example, rather than just treating the symptoms. And we're seeing more R&D dollars going into neurodegeneration now than we saw going into cancer over the past 10, 20 years. And if you think about the progress we've made there, then that is tremendously exciting. And again, it's not just about the innovators. It's not just about the novel treatments. We've got lots of exposure in the portfolio to the scale builders, or the picks and shovels, if you like, that are underlying that. Whether that's Codexis, which makes a lot of the active ingredients for drug development, or Dassault Systems, which operates in sort of 3D software that can model drug development. So again, lots of ideas coming through the portfolio. And another trend that I would argue is both good from a growth perspective, but also a sustainability perspective, and very good outcomes for society as well as for investors. So I'd say for sustainable growth investors, there's quite a lot to be excited about, and hopefully I've managed to get some of that across. I'm going to give you some bad news though, and the bad news is that it's actually quite difficult to pick the winners ahead of time, as this chart shows. So this is based on the work of a Swedish professor called Henrik Bessenbinder. And what Professor Bessenbinder saw was that it's really a very small number of big winners that drive all of the equity market returns that we see. So this data set is for global equities between 1990 and 2018. And it's for 61,000 companies. And when you rank them, you find that, rank them by return, I should say, you find that 61% of them have destroyed value over that time frame. And another 38% of them have delivered a return which is less than just the 1 month T-bill rate in the US. So that means that all of the wealth created over those nearly 3 decades, so $45 trillion in total, that actually came from just 1.3% of companies, 811 companies. So what this means to me is that investors need to rewire their thinking to give themselves the best possible chance of finding those big winners, because it's not this old fallacy investing that it's about getting 51% of your decisions right. That's not the case. It's about finding the very exceptional companies, getting them into your portfolio and holding them in size for the long term. So that's, it is a difficult task, but thankfully there are some trends that, are shared, traits that are shared by a lot of the companies that fit within that 1.3%. And, this is one that we look to within Baillie Gifford. Basically, this chart shows how much money listed companies spend on long-term projects. So capital expenditure, research and development, experimentation broadly. And it compares that to the long-term, compares that long-term investment to the amount of money they spend on sort of short-term stock market pleasing measures, buybacks and dividends. For example, a colleague of mine refers to this as corporate Botox. So the smoothing of profits. So what this line is basically the ratio of long-term investment to short-term superficial measures, and we call it the innovation ratio. And for the market at large, as you can see here, going back to 1995, this has trended downwards over those 30 years to well under 1 today, which means that the average company is actually extracting value, and I think that's why it's large swathes of the index and so many companies are at threat of disruption because they've been underinvesting in their own longevity. And that's something really to watch out for in any company that you look at. Within the Global Stewardship Fund, the ratio sits closer to 2. And that's, I would say, largely because our holdings are run by management teams that have a long-term view, that are incentivized for the long term, often because they founded the business themselves. In many cases, about 2/3 of our holdings, that is the case. And so they're more inclined to invest and to experiment, to remain adaptable in a very fast-paced world. And they don't care about their share price, frankly. Now, because they ignore their share prices, they're also likely to be amongst the most volatile investments. So, what do we do about that? Well, if you're familiar with Baillie Gifford, I think you'll probably know the answer already. We believe that you need to embrace that volatility. So this chart shows the maximum drawdown of our 10 most successful investments since we launched this fund. And we've held most of them for a very long time, 5 years in most cases. And most have fallen by well over 1/3 at some point during our holding. Some have fallen by more than 50%, as you can see. And many of those drawdowns were actually caused by the company sacrificing short-term earnings, as I've described, to invest for the future. So Tesla is the top of the pops there in terms of its 50% drawdown. That actually happened in early 2019, end of 2018, whenever they were building out several new gigafactories, the Shanghai one in particular, and trying to ramp up production and trying to meet very strong demand. And the market punished them for that because it was a short-term hit to earnings, whereas we were applauding that move because they were investing in their own future. But that is a good example of a stock that has been, uncomfortable to hold for us at times. We've seen, I think, 7 drawdowns of more than 30% over the last 7 years in Tesla, and there will be more of those. So for us, it's focusing more on embracing that volatility, thinking more about our hold discipline than our sell discipline, and trying to make sure that we're in a good place to capitalize on these companies whenever they come good. Because if you're prepared to embrace that sort of volatility, the long-term rewards can be really substantial. And if I zoom out and put that short-term volatility into context, you'll see that the yellow part, hopefully you can see my cursor, I'm looking at my other screen here, the yellow part is now pretty insignificant in the context of the upside that we've seen in some of these names. So Tesla's up nearly 1,500%, Shopify 900%, Wayfair 500%, and so on. And those are the kind of amazing payoffs that are on offer for those investors that are prepared to stay the course for many years, rather than trading in and out of companies. And I'd say if you take nothing else away from the presentation today, I remember just this one thing, the shape of this chart, because the fact that just one of those big winners is enough to offset all of the ones that have gone wrong for us, and there have been many on the bottom left-hand side. That's the most important thing about equity investing, yet it's the most often overlooked, I would say. The fact that returns, as I said at the start, are asymmetric. You can only lose 100% of your money in a given stock, but you can make 200%, 300%, 1,500% on the upside if you get it right and if you hold and have the discipline to do so. So that's why we need to shift our mindsets to focus on the upside, to think about what might go right rather than obsess about what might go wrong. And frankly, to beat ourselves up more for missing out on a big winner rather than holding a big loser. And that remains a tremendous inefficiency in equity markets broadly. But I would argue that within ESG markets, within responsible investing communities, the majority of players are entirely focused on the downside. They're entirely focused on risk and on staying clear of controversy. And therefore, this is an even more pronounced opportunity for a different approach to deliver good returns. And that's exactly what we're trying to exploit within the Global Stewardship Fund. I'm going to stop there and see where you want to take the conversation. I hope that I've said some stuff that's a little bit controversial and provokes a bit of discussion, because I really appreciate the challenge. And I'm sure Tom certainly has some questions for me.
Thanks, Alasdair. As Alasdair said, it's time for the Q&A half of this webinar now. I've got a good few questions for you. I'm sure the audience does too. As I said earlier, please feel free to put any and all of your questions to Alasdair using the chat function, which you'll find at the bottom of your screen on the right. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Alasdair, I'll put a question to you first. Fossil fuels will still need to be, still needed to power the energy transition over the next couple of decades. But how do you decide which companies are worthy of being in a sustainable portfolio, perhaps in that context or in any other context? There's some you wouldn't have because they don't act enough on their green promises, or their green promises aren't strong enough?
Yeah, so I've not really said much about the fund at all, I suppose, so it's probably worth just sort of laying out how we think about sustainable investing, first of all, to answer that question. So we have exclusions on this fund. So we're a 70 stock global equity fund. We look at a universe of about 4,000 companies. So that's all companies globally with a market cap of $1.5 billion US and above. And the exclusions that we apply are in what you would call probably the traditional sin sectors, so alcohol, tobacco, gambling, adult entertainment, defense, and fossil fuel extraction. So none of those companies can make it into our funds, but they wouldn't make it into the fund anyway, frankly. So that 4,000 stock universe that I referenced, whenever you remove those 6 sin sectors from that universe, it actually only takes out 350 companies. So, and we do that in a very mechanistic way. We use a screen from MSCI and from Sustainalytics. We take those out and we don't need to worry about them. What is much more difficult is getting from the 5,650 that are left down to a reasonable portfolio of 70 to 100 names in our case. And so what we look to are inclusion factors rather than exclusion factors. And we call these our positive inclusion factors. So it's 3 questions we ask of any company that's under consideration for the portfolio. And the first is societal. So will the company add value for society, significant value for society in the long run? The second is, does it balance the needs of all stakeholders? And the third is, do the management team exhibit a responsible culture? And we think if you can answer in the affirmative to those three questions, then the company is likely to fit with our ethos and is likely to be demonstrating good stewardship, as we would call it. Now, on the exclusions, clearly the fossil fuel companies are filtered out, but they wouldn't pass those three positive inclusion factors anyway. Nor would they, there's two elements to what we're trying to do. There's sustainability and there's growth. I don't think that they also have the growth characteristics that we're looking for. So from a growth perspective, we're looking for any individual stock to have a reasonable probability of doubling over the coming 5 years. And I just don't think that's going to be the case for many of the big energy companies. I'm aware that a lot of responsible investors hold fossil fuel companies in their funds, and their argument is that they're directing a lot of capital towards renewable technologies and innovations in that regard. Frankly, I don't buy it. BP, of their R&D budget, about 1% goes to renewables, and a significant, vast majority of the rest goes to exploration and production, despite the fact that the International Energy Agency has said that we should not be exploring for new oil and gas reserves. So it is greenwashing of the highest order in my view if you see a fund that has fossil fuel companies in it. That's besides the point that they also have a tremendous innovator's dilemma. The engineers working at one of these big oil companies do not want to invent their pals out of a job, I would say. And also, the scale of capital required to really drive forward the energy transition, I think, needs to be of a governmental order. So yes, private companies can help, and we've heard a lot of that out of COP, but you need significant action at a higher level, I would say. So lots of reasons why we wouldn't own big oil.
Moving on to the tech sector, because Baillie Gifford and big tech stocks are kind of, well known together in that regard. Just so we don't get more questions on this, because I'm sure we'll get a lot of questions through, and we already have already. One of them is, with the prospect of increasing interest rates, are the valuations of tech stocks, Tesla, Amazon, Microsoft, are they vulnerable? What do you think on that?
Yeah, sure. So I think tech is having a significant influence on interest rates already in itself. And I say that because I would argue that inflation has been suppressed and will be suppressed in the future by the deflationary forces we've seen from technologies. I've described what they call Flatley's law there, which is the decreasing costs within gene sequencing technologies. That'll be a factor as well. But obviously Moore's law is related to that, and it's driving a lot of these technologies. It's been the increase in computing power. You see the inverse of that with the costs of computing power. And that affects almost every industry now, or certainly it will do in the very near future. So, there is definitely a deflationary effect in the first place. And for that reason, I'd argue that inflation is transitory. And what we're seeing at the moment is really, something that's just as we're coming out of the pandemic. More broadly, though, how does it affect the valuations of tech companies? So it has affected them so far this year because, the sort of CFA textbook view of the world is that, inflation and higher interest rates resulting from it is bad for growth companies because more of their earnings lie further out into the future, which is definitely the case. But if you consider maybe interest rates going from, 0.1, potentially going to 0.25, maybe we'll get up to the heady levels of a couple of percent. That is going to be largely insignificant in the context of our portfolio average earnings growth rate is north of 25%. These technology companies, a lot of them are growing their earnings at 40% or more. So I don't see how it can have a significant effect on the valuations on a long-term view. Yes, it's impacted them this year, and if anything, we're seeing that as a bit of a buying opportunity.
I'll give you a two-part question on Tesla, so we can move away from Tesla and move on to other things, because there's a few in the chat. It's a two-part question. Tony asks, in view of the environmental and social impact of producing electric vehicles, e.g. mining of cobalt in the Democratic Republic of is DRG Congo? I'm not sure. Anyway,
Congo.
How can you justify holding stock in Tesla? And John McHugh asks, how do you feel about Tesla as a company whose share price could hinge or be manipulated on the tweet of its CEO? I'm assuming that's kind of in the context of Baillie Gifford being a big long-term investor.
Yeah, absolutely. So the second one's a fairly straightforward one to answer, because Elon Musk's contribution at times, and particularly in recent days over the weekend, is slightly unhelpful for the sort of short-term direction of the share price. But his contribution is absolutely monumental in terms of the long-term direction of not just the share price of that company, but of that entire industry towards the energy transition. The incumbents in that industry would not have moved towards electric vehicles at the pace that they had it not been for Tesla's contribution. So, yes, okay, he can be a bit of a volatile character at times, and that's a bit frustrating, but it's nothing more than a bit of a wrinkle in the investment case compared to the upside that the company's delivered so far, and that it can do not just through its own shares, but through the whole industry. Now, our approach to holding the shares within a sustainable fund, and clearly there's lots of positives from the technologies that it's deploying, not just in EVs, but things like energy storage, solar roof tiles, and so on. And I would say, I would characterize us as pragmatic ESG investors. So we recognize that there is no such thing as the perfect company. Every company will have wrinkles. So, in the course of our research, whether it's for a new holding or one that we already hold, what we try to do is identify those wrinkles and lay them out as engagement priorities. And then we'll talk to the company about them. And, we're fairly significant shareholders in Tesla, so we do believe that we do have a bit of an ear there, and we can have influence, not just because of the size of the shareholding, but also because, our reputation as long-term investors, which means that we're at the AGM, we're at the next one, the next one, the next one, and their management are quite aware that we're not going away. So, we believe that there is possibly no company in the world that's making a greater contribution to the energy transition than Tesla. And, we need to embrace some of the imperfections to allow it to add its contribution to the portfolio. The question around cobalt supplies in DR Congo is a very insightful one, and that is something that we are concerned about. We had an expert earlier this year come in to talk to us about artisanal mining and how we can look out for that in Tesla's supply chain. And again, it's one of the imperfections that we've added to our list of engagement priorities, and we have spoken to the company about it. So much so, in fact, that they came back and consulted us on their first ever annual impact report to see what we wanted included in that, and that was one of the topics, and we were pleased to see it did make it in. There's lots of ways that we can look at that company. Bringing it back to my comments in the presentation, I think we need to focus on the upside. We need to think about the good that company can do, and not get overawed by all of the downside.
Would you kind of say that those two questions highlight the difficulties of sustainable investing? Because no matter what company you have in your portfolio, there's always the black and white, and that is it the truth you kind of exist in the grey, and that no company is perfect, and you have to make the choice whether the positives outweigh the negatives in that sense?
Yeah, I think that's exactly right. I think the big danger is that people don't take a thoughtful approach to this. So I'm always really pleased when people probe on companies like that and ask the difficult questions, because we should be doing that. Much worse would be to stick all of your assets into a fund that's labeled ESG and invests across the index with some moderate tilts based on data points produced by some of the external providers, and then just sort of tick the ESG box and say that you don't have to worry about it anymore, because I'm pleased that people are giving it more thought than that.
A little bit of a dig on passive ESG investing there. What are your kind of general views, and do you think it is possible if portfolios are well made with the right passive with the right filters in those funds, or do you think it's an active game?
I think it's an active game, clearly. Obvious answer for me, but I could be quite strong on this. I'll try and remain fairly diplomatic. I think that So passive funds are built with tilts that are based on the ratings of ESG ratings agencies, third-party agencies that cover that full 4,000 company universe that I've talked about. So, having the bandwidth to cover all of those companies in detail is just not possible for any sort of research agency. Our portfolio is currently 72 stocks, and we think we're taking a pretty thoughtful approach to looking at all of those across ES and G. Trying to cover a multiple of that, I think, is just it's just unrealistic. So necessarily the kind of analysis that's done on those companies is pretty superficial. It's pretty backward looking. So, typically it's look at the last CSR report and, tick some boxes on your sheet to see where the company's positioned relative to others. And then it's to assign it a score based on the risks present there rather than the opportunities. Very few of these ratings agencies really take opportunities into account. And when you actually look at, the different rating providers and the scores that they issue for companies, they're entirely uncorrelated, which sort of shows that there is no sort of standard there. So for passive funds to then be building portfolios on the basis of those scores that are assigned is just nonsense to me. So, for example, Tesla scores more poorly than a lot of tobacco companies that you see in these indices. It's also the case that they favor larger companies because they have, the manpower, the resource to write the big CSR reports, corporate social responsibility reports, whereas smaller, innovative companies do not. So for full disclosure, the poorest scoring holding in our portfolio is a company called Abiomed, and Abiomed makes the world's smallest heart pump. It works like an Archimedes screw, and it's inserted into your heart whenever you're having open heart surgery. A lot of empirical evidence that shows that company demonstrably saves lives. So survival rates when it's used compared to the previous standard of care go from 50% to 80% in the most severe types of heart attack. And yet it scores really poorly with these ESG ratings agencies because its climate disclosures aren't good enough, and because it's a one product company, and because they have a co-CEO and chair role there. And those are just really minor things in my view compared to the ability to save lives and change the world. So I could go on and on. I'll try and stop there and let you ask some other questions.
It's that grey area again, isn't it?
Yes, yeah, and what it takes is a more thoughtful approach. It takes significant resource and significant research resource, which is why 72 stock portfolio. We have a team of 8 looking at it, and we have a blend of investment managers and ESG specialists.
So kind of moving away from ESG for a little bit, inflation is a huge topic at the moment, and Baillie Gifford, is quite strong on the fact that it's a long-term investment house. How are you taking in, your view of inflation into your long-term investments in equities specifically? So
I'm kind of minded to tie it back to ESG a little bit, because actually I think potentially how a company reports its carbon emissions, the targets that it sets, its disclosures, and so on, could be more of a driver of its cost of capital in the future than where interest rates are or what inflation is. What I mean by that is that if a company is good from an ESG perspective, then it's going to be more attractive to larger swathes of the investment world, and therefore, price of the shares goes up and so on. So, I do think that inflation is, it can only go in one direction from where it has been, and we've seen that so far this year. But I do think, referring back to my previous comments, that it will be transitory. In terms of, to give you another point, in addition to the one I made earlier, in terms of the holdings in the portfolio, we're confident, both because they're growing very strongly, but also because they've got a lot of pricing power. So some of the software companies I've talked about, for example, a lot of them operate on a subscription model, and so they're very adept at passing on any sort of price rises that they see to their customers. And we're seeing that play out actually quite a bit. So Netflix, for example, earlier this year, it raised prices fairly significantly around the world and still saw subscriber growth resulting from that. So it's not something we're terribly worried about in the long term. Yes, there'll be some impacts in the short term, but our time horizon for this portfolio is 5 to 10 years. And I think over that time frame, you're likely to see inflation at or about Bank of England targets, I would say.
I remember that chart you showed us during your presentation where you said there was something like 1%, 1.3% of companies were the big winners, and you basically needed to have those in your portfolio. How confident can you be now to the advisors watching here saying that you'll pick at least some of those 1.3% companies in the future?
Yeah, I think we can have. I mean, the beauty of it is that referring to the slide that came after that, the one on asymmetry, we only need to get 2 or 3 of them into the portfolio to deliver good returns for our clients. So I'd be pretty confident that of our portfolio of 70 to 100, we'll have a couple of real multi-baggers in there. I can't tell you which ones they are ahead of time, unfortunately.
And do you think there'll be sustainable funds, or most of them, or some of them?
Yeah, I think so. I think companies with poor ESG credentials 5 years ago faced a bit of a reputational risk. I think nowadays it's an existential risk, and so I think any company that's not operating well in that regard is just going to be a terrible investment going forward. And that's one of the things I'm most excited about as a sustainable growth investor. So we've seen a huge amount of technological disruption over the last 10, 20 years, some of which I've talked about in the presentation. And that during the pandemic, that technological disruption really has just been focused on a couple of sectors, let's be frank. So it's happened in sort of retail, and it's happened in communications, clearly what we're doing just now. But what we've seen during the pandemic is that disruption is now spreading and no sectors are safe. So energy, of course, I've talked about, is being disrupted, healthcare is being disrupted, and so on. That's broadening our opportunity set as growth investors, I would argue. But particularly because companies now understand the very thin social license upon which they operate, they're all increasing their ESG credentials. And as a result of that, there are more and more companies available to us to pick as sustainable growth investors. And therefore, I would argue that our opportunity set is broader than it ever has been. So in terms of why am I optimistic or why am I excited about the future, it's because of that sort of deeper pool for us to fish in.
And as a final question, that opportunity set you mentioned, what does that look like in China? Because obviously it's a major global economy now. How does that fit into China and sustainable investing?
Yeah, I mean it's a really good question, and the straightforward answer is that it's narrower in China for a sustainable investor, and the Global Stewardship Fund has less exposure to China than you might expect for a Baillie Gifford fund if you read some of the stuff in the press on the likes of Scottish Mortgage and so on. So we've only got 5 Chinese holdings, and it comes back to that point I made about the 3 positive inclusion factors we look to. So the second of those is consideration of all stakeholders. And clearly, when you look at a Chinese company, there's a very large, very interested stakeholder at play that you need to be cognizant of. So for that reason, our exposure to China has been moderated somewhat. And that's been beneficial, actually, over the last 12 months or so. We've seen that regulatory crackdown come in, and we've managed to avoid, the worst affected sectors like property, healthcare, and education, because we've looked at some of these companies and not got them into the portfolio as a result of that. So it's a real sort of conundrum for us because, again, linking together the growth and the sustainability, as the economic center of power shifts inexorably eastward, we'd love to get exposure to that growth, but the sustainability isn't there for us, and we do have that higher sustainability bar within this fund. And so for that reason, it is more difficult to have, the requisite exposure to China.
And as a final question, just a quick 30 seconds, do you think that will improve in China? Do you think you'll have more opportunities in the future? Or is it going to, you think, remain the same over the next 5-10 years?
I think China's notable for under-promising and over-delivering on ESG. And I'm optimistic, for example, committing to 2060 net zero targets. They've got a history of doing better than what they lay out in those targets. And I think the same goes for the private companies as well. We've been engaging with all of our Chinese holdings, on things like emissions disclosures, because frankly, they are laggards in that regard. And they're quite quickly waking up to the fact that this is basically table stakes now, and they will need to do better. So I actually would go so far to say that we'll see the Chinese companies catch up within the next 5 years, never mind, towards 2050, 2060.
Brilliant. Well, thank you, Alice. That's an interesting point to end on after an interesting presentation. So thank you for your insights today and during the Q&A session. Now, before we wrap up, let's take a quick look at those learning objectives again. I think they've just popped up onto the screen. Alasdair has shown us what the most disruptive forces are that will drive sustainable growth over the next decade, which traits we can look for when attempting to spot the companies that will benefit, and how we can rewire our investment thinking, let us embrace the opportunities. So that's all we have time for today. Thank you for your questions, and thank you again, of course, to Alasdair for joining me today and for letting me and you folks at home grill in with our questions. On that note, if your question didn't get answered, Alasdair and Baillie Gifford will do their best to do so after the event. Before we close up, I should assure you that your CPD will be delivered tomorrow. Now, before we sign off, let me just remind you of some dates for your diary. We have a very busy finish to the end of the year at Professional Advisor. So here are 3 events we hope will add value to you and your business. Starting next week, we'll be running our retirement planning roadshow. On Tuesday, we'll be in Harrogate, followed by Knutsford on Wednesday. And on Thursday, the roadshow moves on to the Belfry near Birmingham. If you're in the West Country, you can join the roadshow when we visit Bristol on Wednesday, the 24th. And we'll be finishing up at Butchers Hall in the City of London on Thursday, the 25th of November. Our keynote speaker will be Heather Hopkins from Next Wealth, who will be revealing results of their recent advisor survey on retirement planning. And you'll be able to see presentations from Tony Wickenden on behalf of HSBC Life, Canada Life, Denson's Pensions, Benchmark Capital, and Fiona Tate from advice firm Intelligent Pensions. Then on the 1st of December, we're back with our final working lunch of the year, when we'll be joined by Schroders' Gillian Hepburn, as she and Unique Financial Planning's Philip Martin discuss the very real issues of the younger generation and their obsession with the crypto market. And finally, on 8th of December, for those of you who were unable to attend our flagship PA360 conference in London in October, we're bringing the highlights of that conference to Knutsford for PA360 North. So join us at the Mere for a packed day of more than 30 presentations from leading industry voices, where we'll cover everything from regulations, technology, outsourcing, investment, and just getting to grips with life as an advisor in a post-pandemic world. All in all, that's a total of 11 hours of CPD for those of you who need topping up your hours before the end of the year. That's it for today's session. All that remains is for me to once again thank Alasdair for his presentation and answering our questions. But of course, my biggest thanks goes to you, our readers, for your company this lunchtime. I trust you found this session helpful and worthwhile. And if you did, then we'll look forward to seeing you again soon. Goodbye.